Welcome to the Alternative Investor. The pandemic and the resulting global economic shutdown brought bouts of market distress and dislocations that created investment challenges but also potential opportunities for alternative strategies. We're certainly not on the other side of the pandemic and the related economic implications. To discuss the market and industry dynamics that are likely to impact the environment for alternative investments in the months ahead, we're joined by Pawan Singh, who is the head of multi-strategy for alternative investments at Sanlam Investments. Pawan, thank you so much for your time this afternoon.
Thanks, Natasha. Thanks for having me.
So let's look back at the year that was. I mean, it certainly wasn't a very easy year, both for people individually, businesses, but also for markets, I suppose. How would you characterize some of the events from last year from an alternative investments point of view?
Yeah, look, I think you've captured the essence quite nicely right at the beginning. It's been a tumultuous year. It's been a year of a lot of unknowns, and obviously, the big driver, of sentiment and market returns in 2020, was the pandemic, COVID-19, which continues, with the second wave. We are seeing, continue to see more pain. Well, obviously, because of the way public markets operate, they try to price good news and bad news into the future immediately. And what we saw is massive corrections in the listed market. But obviously, unlisted assets or private assets or alternative assets behave, quite differently from a risk-return perspective. And the outcomes were also different. But having said that, the impact of the liquidity constraints, that was seen globally and locally across public markets also, made its way into alternatives. The difference being that, alternative assets tend to be invested by patient capital and patient investors. So typically the strategies that you look in private markets, such as private equity, private debt, infrastructure assets, and real estate, they tend to be long-ended in nature, and looking forward 5 or 10 years. So, whilst there was an impact on portfolio values and also underlying portfolio companies from a liquidity perspective, because, assets are illiquid and tied for a long period, we didn't see a massive, liquidity squeeze or pull out of those strategies in alternatives. So from that perspective, capital remained, but obviously the challenges that we saw in the listed asset classes, for example, in real estate, in South Africa, the property sector, was down about 50% from its peak, and obviously exacerbated by the fact that, loan-to-value ratios and gearing in the listed property sector was coming under pressure in excess of 50%. We didn't see, similar outcomes in the unlisted market, for example. While we saw, vacancies rise and tenants come under pressure, due to the lower levels of gearing that we typically see in the unlisted space, we saw less of a volatile impact in the portfolio valuations. Private equity or investment in private businesses, also had an impact from a valuation perspective, because they do reference the price to earning multiples of the valuation of different sectors in the listed space, and those sort of fell through and came through in the valuations in the private equity space. But again, we also saw a lot of quality investment businesses, quality businesses that were in the space, and were doing well pre-COVID, but now, because due to COVID, the lack of liquidity, offered investment opportunities that we don't see quite often in the market. So it also provided a lot of attractive businesses at attractive valuations to invest into the space. So that has been net positive. And then, maybe also touch on infrastructure and private debt. So infrastructure, are, investments that are made into housing, toll roads, renewable energy projects, etc., which tend to be very, very long-term in nature and don't tend to be positively correlated to the GDP. So regardless of the market environment, the need for infrastructure assets tends to remain. So we haven't seen a major impact. In fact, infrastructure has been quite resilient, space in alternatives. And then, in the private lending space, which is a space that has been growing quite rapidly over the last sort of 20 years or so, globally, and obviously not the same pace in South Africa, but we have seen larger businesses that access private funding that typically tend to have bigger balance sheets to be more resilient. And expectation was within the SME space we would see a bit more pain. But we actually found, over time, the SMEs were a bit more resilient, and we have a couple of funds that cater to, the SME lending market, and this is a part of the market where banks traditionally don't operate, because these businesses are quite small and don't sort of come into the lending criteria of banks typically. And here, while we saw a bit of pain upfront, especially because of the nature of these businesses, these are small businesses, that have turnovers between 1 to 20 million rand, and they, while the shock upfront in the hard levels of lockdown was quite a bit, they were also quick to come out, as the lockdown started to ease out. And again,
Pawan,
as we've seen, from the government is.
Yeah, sorry to interject there. This conversation is obviously something we could talk on for the next half an hour or so. I'm just curious, before I let you go, your outlook for the alternative investment space, given that we're still in the midst of a pandemic.
Yeah, look, I mean, we continue to see, we'll continue to see liquidity squeeze in the space. And again, what that means is that, businesses will still struggle to access funding. Obviously, having gone through the first wave, businesses have become more resilient and have learned the lessons in terms of how to be cautious about growth and expansion. But there will definitely be, opportunities or liquidity requirements that businesses will need. So as long as private capital or alternative capital can come to the table, I think there's an opportunity to match, much needed capital demand from the suppliers of capital, which traditionally tend to be retirement funds. And also there has to be, we continue to see a sort of growth in impact, investing for impact, which basically blends financial returns, with impact, a visible positive impact, onto the economy. And that's something that we will continue to see increasing, over the coming years. And again, this is a function of that, when you have the capital and you need, that capital to be employed in the main economy, from the fiduciaries or pension funds and trustees, then to the extent that you can put the capital to work in the real economy whilst generating a financial return, strategies like that will continue to be important.
All right, Pawan,
whether it be job creation, green energy, education, etc.
Yeah, Pawan, unfortunately, we are running out of time, but we certainly would love to have you back on the show to talk about that impact investing within alternative investments. But that is Pawan Singh, who is the head of multi-strategy for alternative investments at Sanlam Investments. I'll be back tomorrow with Books on Point.